situations would I be indifferent? I invest in safe assets, my return is 1 plus I. I invest in risky return, then my return is this whole thing in equations 5. Then we say, under what situations would you be indifferent? So you will be indifferent provided that the two are equal. Okay, so the two are equal. So this guy and this guy need to be the same. So that's why you see the left hand side is this. The return from safe asset should be equals to the expected return from the risky asset. Okay, so with that, now let me write it out for you. So I write it out for you like this. I have safe asset. Okay, so this safe asset, and then I have this risky asset. So safe asset is so safe that I got no risk at all. I definitely will get back 1 plus I by the time I hit t equals to 1. But the risky one, we have probability. We say we have this probability of P that it's got defaulted, right? So it's defaulted, then I get nothing back. Probability of it not defaulting, then I get 1 plus I plus the premium. So this is not defaulted. So means you are now safe, right? So we say, then under what situations will the two assets becomes the same? That will be the expected return from the safe asset should be equals to the expected return from the risky asset. From the safe asset, I get 1 plus I. I don't even need to make expectations because it's a certainty, no uncertainty, right? So it is certainty. Then I definitely will get this. But this guy, I have risk. Why I have risk? Because I have uncertainty. So that's why you need to make expectations. And the way you do the calculations would be, then I will say, I have probability of P that I lose everything. I have the probability of 1 minus P that I'm going to get a very good return. Then from here, we say, you just rearrange and solve for X. So this X that you rearrange and solve is what we call the premium. Okay, so the risk premium. So now you see that is this guy. All right. Okay, so let me give you a 5 minutes break. Now it's 10:28, so you come back by 10:33, huh?
Prof.
Yeah.
Can you go back to just now, the one that you were writing? I
Okay.
didn't write finish.
Oh, okay.
Okay, thank you, Prof.
Okay.
Hey, Prof.
Yeah.
Regarding next week, Chinese New Year, do we still have lessons?
No class.
No class for the whole day.
Yeah.
Will there be any makeup class then?
No. You let me see, huh? You see this? Okay. So the schedule is actually in your course outline, even the quiz, huh? Okay, so you see. Now we are here, right? So
Yeah.
now we are here. Okay. Then next week is Chinese New Year. So there's no class. Okay. So not even the makeup. Then after that, you will have the week 5 come back in, right? So we will do lecture 4. And then week 6, then we do lecture 5. Then after that, on the week 7, 22nd February, you will have your quiz 1.
Okay, got it.
So I'm doing this first half, so the quiz date's already set. The one after recess, then Prof. Tang Yang will come in, then she will again confirm with you on when to do the second quiz. Okay, so the
Okay.
first quiz dates is already set. Okay.
Yeah.
Mm.
Oh, then also one more question. Regarding the real, the real interest rate. So can we go back to the notes?
Okay. Let's see.
On the first page.
The first page, yeah.
Yeah, the one where you use the 50 kilo of rice, for example. Yeah, over here.
Okay.
So if the real interest rate is greater than 0, you're saying that the other way around. If we can buy more than 50 kilo of rice this year compared to last year, the real interest rate is greater than 0.
So it should be, I think this one is a bit confusing lah. So it should be like that. This is one group. If I buy back exactly the same, if I buy more, then it's like that. If I buy less, then it's like this.
Oh, okay.
Make sense, huh? Now?
Yeah. Thanks.
Okay.
Hi, Prof.
Yeah.
I would like to ask, what is the impact of not indexing wages to inflation as opposed to indexing them? Does that have a effect on the nominal nominal interest rate?
If you do indexing, simply means I will at least make you as better off as before. If I don't do indexing, so simply means you may you may still have your increment, but I never index to inflations. Then the same amount of, you probably, let's say last time I get paid 1,000. Now I get paid 1,100. You might think, oh, you see, I'm better off. I have 1,100 now. That's a nominal increase in wages. But then what if inflation is actually more than 10%? Then you will be worse off. So you don't do indexing, then you will be make worse off.
So does that mean that causes the real interest rate to have like a much larger gap from the nominal rate and therefore cause the inflation rate to increase? Or is that just
I probably would not want to see it that way, because the indexing is all about inflation. It's got nothing to do with real interest, but more of real wages and nominal wages. Okay.
so
we always want real wages to go up, not only nominal wages. So if your future employer come to you and say, hey, come, I give you an increase in wages of 10%. Then you say, oh, wow, this is a good boss. Give me increase in money wage of 10%. But then later you go and check inflation. Inflation is 20%. Then you probably say, oh, this is a real joker, right? Because inflation is 20%, you only increase my pay by 10%. Right? So you're actually worse off.
right? Okay, thank you, Prof.
Okay.
Hi, Prof.
Yeah.
You
Yeah,
mind
Kristen.
checking if this lecture is recorded? Because like normally, if it's recorded, there will be a red dot on the on the left top corner.
No, this one is not recorded.
Okay. Yeah, thank you.
Okay.
Hi, Prof.
Yeah.
Can you scroll up to the part about the zero lower bound, please?
Okay.
Yeah, thank you.
Prof, I have a question.
Yeah.
So, so when you said like for the safe bond, the riskless bond, the interest rate will be like 1 plus I. I didn't quite get it there. Like, why is
it's
it?
not 1 plus I. The interest rate is I. But then I put in $1, I get back 1 plus I. I get back my $1 together with the interest. So that 1 plus I is my initial investments of $1 plus the returns of I.
So you're assuming there that your initial investment is $1.
Yeah, yeah.
Okay. Okay. Thank you.
Okay. All right. So now let's move on
Prof.
to.
Sorry, I just wanted to ask this expected return for the risky bonds.
Mm,
It's like an idealized thing, right? Because although this would give us like an interest rate that's in between 0 and I plus X, but in actuality, you can only get either 0 or I plus X. You can't get anything in between, right?
I definitely need to, if so long as the assets that I'm asking you to hold is riskier, I definitely need to compensate you for taking that risk. So the X must be some positive value. It cannot be equal to 0. I cannot come and say, hey, Sivam, you hold this asset, no risk, 5% interest. Then Sivam, this is another asset. I also give you 5% interest, but this asset is risky. Do you want to hold the risky one? Of course you don't, right? Yeah. Okay. All right. So now let's get back to our lecture. So point 3, we say risk premium. Basically from this relationship, then what you get to see is that look at the intuitions, what are the things that affected the risk premium? How much X I need to actually give it to you so that you will come in and hold the assets that I asked you to hold, the more risky one. Then we say this risk premium, basically from here, from these equations, is already telling us that P matters a lot, right? So the P matters a lot. So why? Because this P is really the probability of defaulting, right? So the probability of defaulting. So when P is higher, right? So when P is higher, intuitively, without looking at the equations, means this is very, very risky. Then I need to compensate you for more. Okay, so the probability of defaults actually matters a lot, right? Now, then I will leave it to you to work out all this point. The concept is just when the probability of default is higher, I need to compensate you more in order for you to hold that risky asset. Now, the second one, of course, will be, it depends on the degree of risk aversions of bondholders. If let's say I'm an investor that, I love risk, I enjoy taking risk. You ask me to take bond that is higher risk, I don't mind. Then you don't need to compensate me so much. I am already very willing to take the risk, right? So then X would be lower. So if I have a risk lover, right, or risk lover, then this guy probably would have negative premium because he already loves risk so much. But if I have somebody who really hate risk, so somebody who actually have what we call risk aversions, I hate it, then you better make sure you compensate me for higher risk premium. Okay, then usually we say no investor will be risk lover. If you are risk lover, then you won't be an investor, right? So all investor, we assumes that they are risk averse. So in other words, you should actually compensate them higher, right? So who want to play with the money? Nobody want to play with money, right? Okay, so then usually we say people are risk averse. You ask me to hold something risky, can, but you give me higher premium. Okay, so when bondholder become more risk averse, the risk premium will have to go up, even though the probability of defaulting is the same. It's still, let's say the probability of defaulting, let's say, is still 40%. but just because I'm very risk averse, the same probability of defaulting, you have to offer me higher premium. Okay, now, so let's take a look of what we have in this figure 3. This figure 3 is actually the 10-year US government's treasury. So that is the yellow line. The AAA rated corporates bond, BBB rated corporate bonds. So government treasury means bonds from government. So means borrowing from government. So treasury bill, they are borrowing from the government. And these are usually safe because, and we say these are usually what we call riskless because it is issued by the government. Then corporate company, they can borrow also. So these are borrowing from company or borrowing from corporate. So they sell bond. When they sell bond, they give you return. Now corporates can have risk. Okay, so but some corporations will be very safe corporations. Then when these corporations were to borrow by selling bonds, then all this rating agency will come and say, oh, okay, these bonds are still very safe. So they give them AAA. But then some companies are, wow, very risky one. Then they will say, all right, I got to have rate them BBB. Okay, so this one in terms of riskiness, right? So this one, of course, will be the higher risk. Okay, so BBB higher risk, AAA lower risk, and government's bond no risk. Then when I ask you which one should offer you higher return, then of course the one that BBB we have to offer you higher return. So this one we have, let's say, premium that is actually much higher than the lower risk premium. And of course the government's bond, so these bonds basically no premium, zero premium. Okay, so that's why you can actually see the purple line is for the BBB rated, the blue line is for AAA rated, and then the treasury bill is actually for the yellow one, right? So because they have no risk. And then you can actually see during the global financial crisis in 2008 to 2009, all this, even though you are rated AAA, you can see that they need high return in order to encourage people to hold their bonds. Okay, because everybody is so frightened, right? So during this 2008, 2009, so everyone's frightened. So you can actually see that the degree of risk aversions increases. So everybody becomes very frightened because of that uncertainty. Therefore, you need to give them higher premium, right? So you give them higher premium, higher return for investor. Okay, now let's move on to the next sections. So for these next sections, we said we look at the role of financial intermediaries. Before that, we only look at banks, right? Now we want to look at something beyond. So we say until now we have looked at direct finance. So what is the meanings of direct finance? We assume that we borrow directly from the lender, right? So I have a borrower no need anyone, they just get from the lender. But the actual fact is that borrowing and lending take place through financial intermediaries. So these financial intermediaries will actually collect fund from saver and then loan it out. So they become a middleman. So that's why we say intermediaries. Now, so among these are basically banks and non-banks. Okay, so banks we know, but non-banks, who are these? They are the mortgage company, they could be the money markets fund, and they could be the hedge fund, right? Now, so we say because these people are growing in the shadow of banks, so the non-banks are growing in the shadow of banks. So we say the non-banks parts of the financial system is what we call shadow banking. The banks are, of course, they are the banks, so they are not being shadow. But then all these mortgage company, money markets fund, hedge fund, they are non-bank. So all the non-banks inside the financial system is what we call shadow banking. Now let's take a look at point 5. So look at this figure 4. They say we show you a simple bank's balance sheet. So when we see this, we say the banks would have asset of 100. Then like what we say, asset is what they own. This one we talked many times already. Liabilities will be what they owe, right? Okay. So this left-hand side, right-hand side must be equal. So now suppose now I am a rich man. Then I wanted to have a bank. So what do? I will say, all right, I come in and I directly, because I'm so rich, I can directly invest $20 to set up this, right? So I have $20 of my own financial investments. I put in and say, let's set up these banks. So I have this 20, but how can I manage to have assets of 100? Then I must have these liabilities of 100. My liabilities must be 80. So what is this 80 come from? It must be coming from the borrowing, right? So the initial $20 is actually my own fund. Okay, I borrow 80 so that I can afford an asset of 100. So then we say, now we consider banks that have assets of 100, liabilities of 80, capital of 20. Note that the capital of 20 can be seen as the owner of the banks who directly invested 20 of their own fund into the bank. So what will be the remaining 80? 80 they borrow, okay, from other investor. Okay, now then we say the liabilities, who actually lend it to them? This could be household who actually deposits some money in. And these checkable deposits usually pay no interest, but then it could be also interest paying deposits. So some deposits you go in, you get interest. Checkable deposits usually with no interest or very low interest. The reasons is because you just want to keep your money so that you can write check, right? So that's why checkable deposit. So, or you can actually borrow from investor, from others banks. So these are all the things that inside your liabilities, like what we did the last time. So we say it could be deposits, it could be also borrowing from others bank, right? So borrowing from others, investor, right? Other than yourself. All right. Now, then what would be the asset? Asset in this case would be our reserve. So reserve could be our asset, or we say is the central bank's money. Or it could also be the loan that I have to consumer, right? I loan it to consumer, or I loan it to firms, or I loan it to banks, or I make mortgages, or it could be bonds that you're holding. So these bonds could be the bonds that you hold from the government, or it could be other corporate bonds. Okay, so these are your so-called assets. Okay, so simple enough banks balance sheets. Now, then we want to look at the choice of leverage. So what is the meanings of leverage? Leverage is like, even when you play a seesaw like this is leverage. Okay, so now we say capital ratio is defined as the ratio of capital to asset. So the ratio of capital, so that is, maybe I put it down like this. So we say capital ratio would be how much capital I put in divided by my asset. Maybe I put like that. Total capital divided by my total assets value. So I have $20, but my asset is 100. So this is actually equals to 20%. But what is the meanings of leverage? Leverage is just the inverse of your capital ratio, right? So leverage is defined as the ratio of assets to capital. You see, just the inverse of your capital ratio. Huh? So we say leverage ratio is actually equals to your assets divided by your capital. Or we say this is just equals to the inverse of your capital ratio. Now, so you look at this, then of course in this case it is equals to 5. Now, so from here, then you can actually say the higher the leverage ratio, the more risky the bank can be, right? Because you have very little asset. You have very little asset, and then you try to support. Sorry, you have very little capital. Then you try to borrow a lot so that you can afford to have that asset. Then we say this is very dangerous. It could be because you are leveraging too high, right? So because towards the end, capital is really what you really own. All the others are you are trying to leverage it. So now in this case, let's see what leverage ratio banks would actually want to choose. So we say the good thing with this leverage ratio would be, now imagine, you just, for example, I want to go out and buy a house. I want to buy my condominium. I got 100,000. That condominium is $1 million. Then I got only 100,000. Then what happened? 100,000 is my own fund. In order for me to own this asset of 1 million, I need to borrow 900,000. Okay, so I'm borrowing 900,000. And you look at the way I do my leveraging, I use 100,000 to afford an asset that worth 1 million. Okay, but compared to another case where I already have 500,000 and I want to buy an asset that's worth 1 million, then how much do I need to borrow? I just need to borrow 500,000. Okay, so if you are the bank, the first persons who come to you and borrow 900 with 100 own fund, the second one come to you and borrow only 500,000 and use another 500,000 as own fund. To you, being the bank, who is safer? Who is a safer borrower to you? The first one or the second one?
Second one.
The second one, right? The reason is because the second one is not doing a lot of leveraging, but the first one is doing a lot of leveraging. He's just using 100,000, hoping that he can own an asset of 1 million. But the second one is he has already 500,000 trying to own a $1 million of asset. Okay, so we say, but high leverage sometimes is important. The reasons is because why people leverage so much? Because that usually offer higher expected profit. I put in a little bit, I can get a lot, right? So that's what I have. But at the same time, we say these people who have high leverage would have higher risks of bankruptcy. I only have 100,000 trying to own a $1 million assets. This one, at any time, he can go bankrupt if he cannot pay off his loan, right? Okay, so same thing happens to banks. So we say, what leverage ratio to choose? Two factors. First is by increasing the leverage and decreasing its own fund, what happens is that banks would increase its expected profits per unit of capital. Okay, so I leverage more, I can expect higher profit. But then why shouldn't bank choose high leverage? You choose high leverage, then that means you can have high profit, but you are also become higher risk of insolvency. So exactly like household behavior, you can turn to becomes insolvent. Now, I maybe share this with you guys. You guys are youngster, year 20 and slightly above 20. I have my PhD students graduated long time ago, age now 36. Then I have dinner with him and his wife last weekend. Then we sit down together and then we started to talk about building our wealth, right? Financial wealth. Then he was saying, I hope somebody were to tell me when I was a lot younger that I need to begin to build my wealth when I'm young. Then what would be the best way to build your wealth? Now, you have two types of income. One types of income is what we call active income. Another types of income is what we call passive income. Active income is you work, then you get that income. Passive income is you don't work, but you still get that income. You sleep, you also can get that income. That is what we call passive income. Last time, also, I have my classmate. So I was like, wow, very good in studying, right? First class students, wow, very proud of myself. Then they got one joker in my class, right? But he's my best friend now. Then he said, this guy never study, then graduated with second lower. But then every time he looked at me, he's now a lot well-to-do than me. I'm just a poor professor in NTU. But then he's a lot well-to-do than me. You know, then what did he say? He said, you are still very stupid, even though you got your first class, but you're still very stupid. Why? Why can I actually build my wealth? Because I make my money work harder than me. So I can go to sleep, my money work, right? So he tried to get a lot of passive income. So the best things to do is next time you guys go out, right? You get your salary. Don't just go and spend. Try to go in to buy some good stock, right? So as saving, then you will see. You just have to, look at how the stock is actually moving. If you go into a good company, then the company will help you to generate dividends, right? So that's what we say you should do. But of course, when you do that, you have to be very careful. If you try to go into some people also have a tendency to buy houses, right? But then when you buy house, that is good because you're trying to leverage. You started off with small capital, then you buy a big asset, then you're leveraging, then your wealth will actually go up. But then if you leverage too much, also you have to be very careful because at any times you can become insolvent, right? So that's why in Singapore, we say you cannot, if you're already paying debt of around 60 to 65% of your income, right? Let's say you get $10,000. You're already paying your housing loans of 6,500. No banks will actually want to lend it to you anymore because they are frightening of you going to become insolvent, right? Now, so that is the concept of insolvency. Now let's look at F. So we say leverage and lending, right? So suppose a bank has chosen its preferred leverage ratio. So let's say this bank decided I would leverage 5 times. I have asset of $20. I have capital of $20. I leverage it 5. That means I will get an asset of 100. Okay. And suppose that the value of its asset decline. So what happened is at first I started off with assets, right? I like what we have just now. I have this 100 of assets. I have my own fund, right? So this own fund, we call capital, right? So I have capital of 20. Then I borrow, that will be my remaining liabilities, or we say borrowing, right? Or I think I will just use the same term. So if here you use the term liability, I continue to use liabilities. So I will have that liabilities of 80. Now, for this case, you see the way you leverage is just you use 20, right? So 20, and then have an assets of 100. So your leveragings look good, right? So you are actually having leverage ratio of 5. Now, what is going to happen? Suppose these things suddenly decline, right? So if these things suddenly decline, then what is going to happen to you? You probably would realize that because of the value of your assets that has already declined, then you probably notice that your leverage ratio would actually increase because the assets that you have at first is now having low value, right? So you probably notice that the assets you have now having lower value. So this guy is declining, right? Then your capital ratio will be higher. You are leveraging more. Now you say the bank is still solvent, but it is more risky than it was before. Okay, so it's just the same like what we say. Suppose now I borrow, like what we say, I borrow 100,000. Sorry, I borrowed 900,000, right? I have my own cash, let's say of 100, right? Then I go and buy this property, that asset is 1 million. Then it's fine. But what happens is that this house that I own now, out of sudden, have decreased in value, let's say to, instead of it's worth 1 million, now let's say these things now worth 800. What does that mean? That means from the household perspective, this is going to be bad. Bad as in you are still borrowing 900 for an asset that only worth 800. Okay, so this is actually bad from, let's say, a household perspective. Same thing, if these things were to happen to banks, then we say this is going to be bad too. So but still, it is possible that you remain solvent, but now you probably can be more risky than before. So what will then the banks do? So the bank may then want to ask their investor, hey, because now this asset is actually worth less now, I probably would need people to come in and provide me more fund. Or I may want to actually shrink the size of my balance sheets by calling back some loan, right? So because my assets value is declining, let's say from the bank perspective, my assets value is actually declining. Then it's either I quickly ask people to give me more fund, ask investor to give me more fund, or I will have to cut down on my balance sheet by saying that I don't want to loan out so much anymore, right? So I want to make myself solvent. But then we say by calling back all this loan, the capital ratio can actually return back to the desired level that you want. But then you will see that your bank lending is actually going to decline. Okay, so bank lending is going to decline and you becomes less profitable because your profit is actually come from lending. So you would actually end up making less profit by calling back loan, right? So these things usually happens during financial crisis. So financial crisis usually happens is because the value of assets for some reasons decline, right? So then it's actually affected the household balance sheets as well as, let's say in this case, it's actually affect the bank's balance sheets, right? So bank balance sheets will be badly affected. So then to solve this problem they have in the bank balance sheets, they will either ask for more borrowing from investor, right? So they increase more borrowing from their investor, or they will basically cut down, right? So cut down their balance sheets. So the way to cut down the balance sheets is that they do not want to loan out so much, so they will reduce their loan. But we say this is usually tough. The reasons is because how can you call back your loan so suddenly, right? So that's something we need to take notes of. We say what would happen. The problems is what would happen when bank become insolvent and cut lending. So when banks becomes insolvent, then it can actually trigger to another problems that we call bank run. If I were to tell you any banks out there were to become insolvent, that they cannot pay back their depositor, then everybody will run to the bank and ask for withdrawal. Then we say an insolvent bank can lead to bank run. And then we say, what
Yeah.
if banks cut lending?
One
If
just mutual.
banks cut lending, right, then household will get affected, right? So you can have household can get affected, or banks who actually borrow from this bank will actually get affected, right? So that would be the things that usually happens during financial crisis. Now let's move on then.
Prof, I have a question.
Yes.
If you scroll back up a
Mhm.
little bit to leverage ratio,
Mm,
I'm confused. So right here, where
mm.
you said if a bank is chosen as preferred ratio and suppose that the value of its assets is prime. So if I get it correct, the leverage ratio is assets divided by, in your example given, own cash, the capital. Yeah.
Mm.
If your assets are worth 1 million and they decline to 800,000, doesn't that decrease the leverage ratio from 1? So like that from 10 to 8?
Oh, yeah.
I'm
It
so
should be, yeah.
confused.
Oh, okay. So your leverage ratio by right should be your assets divided by your capital, right?
Yeah.
So it is now the assets value that has actually gone down, right? So assets value that has gone down, but your capital is still the same amount of capital. So, so I think the ratio is actually should be declining, huh? Yeah. Okay. So now we say, we try to, with all this, right? Then we try to bring it to our ISLM model. So we say we extend this ISLM model to reflect the distinctions between the nominal interest rates and the real interest rate, and also the policy rate set by the central bank, right? And the interest rates faced by the borrower. So we now try to distinguish them, right? So let's see what happened is this. So suppose now I have these IS relations. So IS relations now, we say it will have to be this guy, right? So where at first your Z is a functions of C, I, and G. So consumptions is functions of disposable income. This one is fine. Investments depends on your income, but investments also depends on your real interest rates, right? So depends on this term. Now, what happened is this one now have to add in the risk premium. Okay, so the X here denote the risk premium, and then these terms is actually the real interest rate. Okay, so now for the LM relations, central banks basically control only the nominal interest rate. So the expected inflations get in, the risk premiums actually go into the IS relations. Now, so what has changed is actually the IS curve. The LM curve has not changed. So there are two changes to the IS relation. The first one is we already put down the expected inflations. The second one is we put down the risk premium. So that would be the main difference compared to the older versions, right? The previous IS relations. So with expected inflations, let's say pi e, this means that spending decisions depends on two things: the real interest rates R, right? So depends on the real interest rates R given pi e, right? So if I know pi e is given, then my R, it should just be equals to I minus pi e, but this is given, then I can actually say this, let's say it's constant. So R will change when I change. So when I increase, then R increased. Now the risk premiums capture the probability of default and also the level of risk aversions. So X will increase if probability of defaulting increase. X will also increase if people becomes very risk averse. So risk aversions increase, you also need to give me more premium, right? So that I can hold risky asset. So as a result, we say these LM equations is the nominal policy rates that's determined by the central banks. So it's actually about the I. But the IS equations is the real rates, real borrowing rates, the rates that the consumer and firms can actually borrow. So this is all about the R, right? So R, and this R we say, of course, now is I minus pi E together with the premium, right? So we say together with the risk premium, okay? I think maybe I should not just say R is that R is just this one, then R plus X, then this is the premium. I should actually make it like that so that it's not confusing. Then we say the central bank, however, can now choose I in such a way that it can achieve its R, right? That it's one. So that this one we already give example. So now because of that, then we can actually say if central bank can choose a nominal interest rate to achieve a given R, which is R bar, then we say LM can be functions of real interest rate also. So now we further rewrite the equations into this, because this is now I minus pi E, right? So I minus pi E. So I have it like that. So now the main difference is that these two equations now become functions of real interest. Okay, so this one becomes functions of real interest rates as the R. Now, so let's try to see how would financial shocks can actually affect the economy. So for financial shocks, that means things becomes very uncertain. So we say with financial shock, uncertainty would increase. Whenever things becomes very uncertain, it is possible that it affects people risk aversions. So these risk aversions would actually increase. When I see shocks, I see uncertainty, then this can affect my risk aversions. So suppose risk aversions for some reasons increases, then therefore we would need to encourage people to hold risky bond by giving out more premium. Okay, so now we say this X for some reasons increases. Then what would happen for the same policy rates of R? The borrowing rates become higher because borrowing rates includes the X. Okay, now this will lead to a decrease in investment, and therefore IS curve shift to the left. So we say when X increases, okay, then with the same R, so with this R that is equals to I minus pi E, these other rates of R plus X must go up. And this is the rates that the investors see, right? So to investor, their cost of borrowing has gone up, even though governments has not done anything, right? Governments didn't do anything. Central banks didn't do anything. So the cost of borrowing increases. And then because of that, investment decline. And therefore, IS curve shift to the left. Now, what you will see is that you will see that at first I could be here at this point, right? So I could be here at this point where my IS equations, I would have C0, Y minus of my tax, there's nothing happens here, but my investments I0, right? Then I would have this, how we write is that I would have my Y has not changed, but I have R plus, let's say, X0, plus government spendings of G0. But now because of higher X1, then I will still have C that is here. But now my investments becomes I1. Y could still be the same, but now I have this R plus X1, then plus my G0. So the entire curve shifts to the left. And if I don't change any interest, this policy rates has not changed, then I'm just going to move from an equilibrium at point A to A prime. Okay, so I'm just moving from A to A prime. But what happens? You can see that the financial shock lead to a decrease in output, right? So we see that a financial shock leads to a real shock of a lower output. Okay, now the next question then is, what can policy do, right? So policymakers look at this, hey, come on, bad, huh? Then what should I do? I probably will say, now I might have recessions, right? So these things could give me recessions. Then what can they do? They are thinking of how to remove recessions, right? How to remove recessions or how to increase output. Okay, so what do they need to do? Now, of course, the very first things they can do is use fiscal policy. IS curve shift to the left, you shift it back to the right. So what do? You say, all right, I will do this. What I can do is I increase G. Okay, so I can see maybe I can increase this G, or I can reduce tax so that my C is higher. Okay, so then we say, what policy you can do? You say, let's look for fiscal policy. Then fiscal policy would be, you want, your aim is to shift IS to the right. And the way to do that, first, you say, I increase government spending. Second, I reduce tax so that my consumption is higher. So all this basically will help me to increase my Z, and therefore my IS curve shift to the right. So that's the first policy. But then when you do this, you would have problem. Problem with what? You look at this public saving. Public savings is supposed to be the tax revenue that you have minus government spending. You raise government spending, you reduce saving of public sector. You reduce tax, you further reduce public saving. And these reductions in public saving can give you what we call budget deficit, right? It can give you budget deficit. Not very favorable, okay? So we say a large increase in G or a decrease in T may imply a large increase in budget deficit. So you say you don't like this also, right? Now, then we say, Now, if not this, then what can I do? Then we use monetary policy. Then monetary policy, what can I do with monetary policy? You say, let's look at this diagram. We say, maybe I don't want y prime. I want to go back to y. So what do? You want to go back to y? Y is here. But IS have shifted. So what do you need to do to your LM? You need to shift it down. And you need to shift it by a lot to here. Okay? Now, then to a point where now you have a R bar 1. And what do you realize in terms of your R bar 1? It's become negative. It is possible that it become negative, right? So we say a sufficient decrease in the policy rates can be enough to bring the economy to point A double prime. So this is A double prime, okay? Keeping output at its initial level. Okay, but of course, to do this, your real interest rates have to become negative. Then why real interest rate become negative? We say I equals to R plus pi E. R equals to I minus pi E. So if I go for 0 lower bound, then I minus this thing. Then you can actually see that if this is positive, then it's possible that your real interest rates become negative. Okay, so that is exactly the same diagrams. Okay, exactly the same diagrams like this. Okay, now this is where we stop for the lecture, but I know that some of you may be rushing for your class. You can actually go for your class if you have the next sections that follow. For those who can still stay on, I probably would hope that you can watch this video. For those who need to go on, then you just go to YouTube, type in subprime mortgage crisis. But for those who can stay on, then let's watch this together. After watching this, you will see that the last sections of your textbook, you can understand a lot better, right? So let's take a look. Can you hear the sound? Just now, can you hear?
No problem.
No,
No? Okay, let
I
me
think you need
just-
to select the share sound.
Okay, so let me share. Can you hear now?
Yes.
Yes, okay.
What is the credit crisis? It's a worldwide financial fiasco involving terms you've probably heard, like subprime mortgages, collateralized debt obligations, frozen credit markets, and credit default swaps. Who's affected? Everyone. How did it happen? Here's how. The credit crisis brings two groups of people together, homeowners and investors. Homeowners represent their mortgages, and investors represent their money. These mortgages represent houses, and this money represents large institutions like pension funds, insurance companies, sovereign funds, mutual funds, etc. These groups are brought together through the financial system, a bunch of banks and brokers commonly known as Wall Street. While it may not seem like it, these banks on Wall Street are closely connected to these houses on Main Street. To understand how, let's start at the beginning. Years ago, the investors are sitting on their pile of money, looking for a good investment to turn into more money. Traditionally, they go to the U.S. Federal Reserve, where they buy treasury bills, believed to be the safest investment. But in the wake of the dot-com bust in September 11th, Federal Reserve Chairman Alan Greenspan lowers interest rates to only 1% to keep the economy strong. 1% is a very low return on investment, so the investors say, no thanks. On the flip side, this means banks on Wall Street can borrow from the Fed for only 1%. Add to that general surpluses from Japan, China, and the Middle East, and there's an abundance of cheap credit. This makes borrowing money easy for banks and causes them to go crazy with leverage. Leverage is borrowing money to amplify the outcome of a deal. Here's how it works. In a normal deal, someone with $10,000 buys a box for $10,000. He then sells it to someone else for $11,000. For a $1,000 profit, a good deal. But using leverage, someone with $10,000 would go borrow $990,000 more dollars, giving him $1 million in hand. Then he goes and buys 100 boxes with his $1 million and sells them to someone else for $1,100,000. Then he pays back his $990,000 plus $10,000 in interest. And after his initial $10,000, he's left with a $90,000 profit versus the other guy's $1,000. Leverage turns good deals into great deals. This is a major way banks make their money. So Wall Street takes out a ton of credit, makes great deals, and grows tremendously rich, and then pays it back. The investor this and want to piece the action. And this gives Wall Street an idea. They can connect investors to the homeowners through mortgages. Here's how it works. A family wants a house, so they save for a down payment and contact a mortgage broker. The mortgage broker connects the family to a lender who gives them a mortgage. The broker makes a nice commission. The family buys a house and becomes homeowners. This is great for them because housing prices have been rising practically forever. Everything works out nicely. One day, the lender gets a call from an investment banker who wants to buy the mortgage. The lender sells it to him for a very nice fee. The investment banker then borrows millions of dollars and buys thousands more mortgages and puts them into a nice little box. This means that every month he gets the payments from the homeowners of all the mortgages in the box. Then he sicks his banker wizards on it to work their financial magic, which is basically cutting it into 3 slices: safe, okay, and risky. They pack the slices back up in the box and call it a collateralized debt obligation, or CDO. A CDO works like 3 cascading trays. As money comes in, the top tray fills first, then spills over into the middle, and whatever is left into the bottom. The money comes from homeowners